Welcome, everyone, and thank you for watching. Today, we are going to talk about the new retirement rules, understanding the Secure Act 2.0, and some other key insights for your retirement planning. Before we jump in, let me tell you a little bit about myself and my company. My name is Chris Foster, and I am a financial advisor and partner at Full Cup Financial with John Keeble. John has worked in the financial planning industry for over 30 years and is a certified financial planner. He lives in Athens, Georgia, and is married to his college sweetheart, Beth. John moved from Atlanta to Athens in 2016, where he and Beth love riding their horses and playing music when John is away from the office. John has 2 children and 4 grandchildren. I have been in the financial planning industry since 2015 and am an investment advisor representative and registered rep. I live in Homer, Georgia, about 35 minutes north of Athens, and am married to my high school sweetheart, Shay. Together, we have 2 children, Charlie, who is 4, and Caroline, who is 1. John and I have been business partners since 2019, and we designed our webinar series to empower and educate, equipping individuals with the tools and insights needed to navigate the complexities of their financial world. Our mission is rooted in the belief that each individual, family, and organization can cultivate good stewardship through proactive engagement with their financial landscape. We recognize that everyone has a financial plan, whether consciously acknowledged or not. However, the distinction lies in its proactive nature. Our aim is to guide you in crafting a proactive plan tailored to your unique goals and aspirations, ensuring meaningful outcomes for you and your loved ones. Throughout these webinars, we will explore key areas of financial management, from comprehensive planning to strategic investment approaches and risk management strategies. Our goal is to provide you with some knowledge and resources necessary to make informed decisions and navigate your financial journey with confidence. So now that you know a little bit about me and Full Cup Financial, let's talk about some new retirement rules. So here's our challenge. The Secure Act 2.0, setting every community up for retirement enhancement, has passed, making it the most significant piece of retirement legislation since the original Secure Act was approved in 2019. With a total of roughly 100 provisions mostly around retirement plans, we need to first get our arms around the key changes and assess the implications. The good news is that there are numerous benefits to investors relating to more time to save, more ways to save, and more ways to use those funds. The challenge is simply absorbing the breadth, depth, and timing of the changes. Most of these provisions are effective in 2024. However, others are pushed out all the way to 2028. Today, we're going to place our findings under one big umbrella and highlight key changes that you should know about. What we'll dig into today are the highlights of what is called the Secure Act Parts 1.0 and 2.0. The first part was passed into law in December of 2019, and version 2.0 passed in December of 2022. The impact is far-reaching, from the silent generation and boomers who are thinking about estate plans, to boomers and Gen Xers focused on retirement, to millennials and Gen Zers who will be the recipients of a great wealth transfer in the coming decades. As we all know well, taxes are complicated and impact your savings, investments, and retirement plans. Generally, the new rules are very savings-friendly. However, they require that everyone reevaluate their financial plans in order to capture the opportunities they present. In addition, the government sees businesses as the conduit to help expand and promote retirement savings by their employees. I want to make sure you understand how the changes will impact you, your family, and if relevant, your business. Let's get started. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation. I'm a financial advisor and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then develop a plan for retirement that takes taxes into account. Now you may be thinking, what parts of the Secure Act will specifically impact me and my plans for retirement? And that brings us to our first key. The Secure Act is giving you more time to save for retirement and provides great opportunities to save and reduce taxes. So what does more time to save mean? There are a number of positive changes to age limits, some allowing you to contribute longer to your plan, and others allowing you to hold off on taking mandatory withdrawals from your retirement accounts. Let's take a closer look. In the past, savers were forced to withdraw money from their IRAs starting at age 70 and a half, whether they wanted to or not. Those withdrawals are called required minimum distributions, or RMDs. The Secure Act has now increased the age you start taking those forced distributions all the way to age 75, depending on your current age. As you see on our table here, If you were born between 1951 and 1959, your required withdrawals start when you turn 73. Those born in 1960 and later will not start taking RMDs until age 75. This gives your money more time to potentially grow tax-free. Remember, however, building up large IRAs means larger RMDs in the future, which can have tax consequences when it's time to start drawing down your retirement assets. In the past, failure to take a prescribed RMD resulted in a 50% penalty. That has been reduced to 25% with a 3-year look-back, and further reduced to only 10% if you correct the error in a timely fashion. Lastly, the new law eliminates RMDs for Roth 401k, 403b, and 457b accounts matching the rule for Roth IRAs. So the question becomes more about the benefits of rolling the plan over to an IRA, investment options, fees, service, etc. All good news. Surviving spouses can now adopt their deceased younger spouse's RMD schedule. The primary benefit of the new rule would apply to older surviving spouses who now can assume a deferred RMD start time. Benefit: if they don't need the money, they can delay withdrawals, allowing the potential for the account to grow. Another benefit is that the RMDs would also be smaller than if the surviving spouse treated the retirement account as their own. Remember, RMD percentages increase with age. If the surviving spouse passes away before RMDs begin, the new 10-year RMD disbursement rules do not apply, meaning the eligible designated beneficiary could stretch the payouts over their life expectancy. Previously, you could only contribute to your IRA until age 70 and a half, and then you would be forced to start withdrawing RMDs from the account. The new legislation gives those wishing to work longer more opportunities to save and the potential to create a larger nest egg when they finally retire. First, in 2024, catch-ups will be adjusted for inflation. Second, and this is important, if your client makes over $145,000, it's mandatory to deposit the catch-up into a Roth account. If the employer does not offer a Roth, the employee will not be able to make the catch-up. Next, starting in 2025, a special enhanced contribution has been created for a very narrow bracket, those aged 60 to 63. $10,000 or 150% of the regular catch-up amount for 401k and 403b. $5,000 or 150% of the regular catch-up amount for simple plans. The table frames the catch-up contribution changes by age. 49 or younger catch-up is not available. Standard catch-up for those 50 to 59 and 64 and older, $7,500. Special treatment for those 60 to 63 in 2024. Greater than $10,000 or 150% of $7,500 in 2024. The bottom line is that the rule changes allow for participants in IRA, 401k, 403b, and simple plans to contribute more to their plans each year. So if you can keep setting money aside each year, that's great news. You'll defer your taxes and grow more savings for your retirement years. If you're thinking, these new rules make me think I should consider putting more money aside for retirement, it's a good thought, because that's what the Secure Act rules help people do, including Roth plans at work, auto-enrollment in plans, help for part-time workers, and help for young families and professionals. Let's take a look. Aside from more time to save, the Secure Act now provides more options to invest for your retirement. You'll see many coming slides address changes to workplace retirement plans. Let's explore this important component and how they relate to your retirement funding efforts. There are a significant number of changes related to Roths both for personal retirement IRAs and in employer-sponsored retirement plans. Clearly, starting in 2023, the addition of employer contributions to the Roth side of the plan equation is a great opportunity to build assets that will escape taxation when withdrawals begin. Important to note, it is not mandatory or automatic for employers. Offering you matching after-tax contributions to company Roth plans are entirely at their discretion. For those employees making more than $145,000 annually, your only option is to have catch-up contributions to a Roth account. The only exception is if the plan doesn't offer a Roth options, no RMD will be required. And it's worth mentioning again, RMDs will be eliminated for Roth, 401k, 403b, and 497b accounts starting this year in 2024. No need to roll Roth 401k to Roth IRA simply to avoid RMDs, although other good reasons might exist. Starting in 2025, to encourage and increase retirement savings, your employer is required to auto-enroll you in their 401k or 403b plan. Then you'll have the chance to opt out if you like. In year one, the employer will determine how much of your salary they can allow you to put aside for savings. It will be between 3% and 10%. In years 2 plus, that number will increase to between 3% and 15%. In addition, that number will auto-escalate by 1% annually. Those new to the workforce or changing jobs in 2025 stand to benefit the most. Studies have shown that auto-enrollment is increasing 401k balances, so Congress wants to continue the good work. But we all know, the earlier we start, the greater the potential to create more money for retirement. This might be a good time to look at your own 401k savings and consider if you are saving enough. Is that the right place to put your retirement savings? How much will your employer match? Some business types are exempted from auto-enrollment requirements, and this is something we can discuss one-on-one to see if that affects you. Companies now have more freedom to offer annuities inside 401k plans. Why is this important to you? One of the hardest parts of retirement income is making your total savings last the rest of your life. Annuities are insurance products designed to turn a portion of savings into a stream of income that lasts a lifetime. They are a very interesting solution to help address the question, will I live to an advanced age and run out of money? The new legislation is casting a wide net and providing small businesses another way to attract, retain, and help their employees save for retirement. The starter 401k is a good place to start, though it may not be as attractive as traditional plans because employers are not required to match your contribution, and contributions are lower. It is, however, a path in the right direction to help boost overall retirement savings. Next, we have some good news for part-time workers who also want to save for retirement. Employers with a 401k plan must allow employees to contribute to the plan once they've worked at least 500 hours for 3 consecutive years, or 1,000 hours throughout the year. This is especially good for some women who may work part-time for caregiving reasons and often have less saved for retirement. Heads up. If you are a part-time employee, check with your employer about when your 500 hours start and end. It may not be as clear as a calendar year. Beginning in 2023, the Secure Act added 2 new options for Roth contributions to simple and SEP plans. Although it won't be a requirement for you as an employee to put this in place, it's there if you want to take advantage of it. Effective in 2023, you can offer your household employees, nanny or cleaning person, a SEP IRA plan. It's a nice benefit depending on your financial circumstances. Simple and SEP plans for Roth provide a simplified way for a small business with 50 or fewer employees to contribute toward employee savings, and yours if you're the business owner. Previously, Simple and SEP plans only allowed for pre-tax funds, which are taxed when you make a withdrawal. Additional employer contributions will be allowed for Simple IRA plans in 2024. These will be capped at $5,000 per employee, in addition to the required matching, or 2% of pay elective non-contribution. Once again, there may still be good reasons to roll a Simple or SEP assets to a Roth IRA. The availability of investment options, fees, and service should all be considerations. These rules are especially beneficial for new families and young professionals. Highly compensated individuals are ineligible. Money must be held in cash or equivalent, and participants must have monthly access to funds. Since many Americans don't have rainy day funds, the emergency savings account can provide a way to regularly set aside some money every year for unexpected expenses. And you get to do so by using your retirement plan. While it's only offering you $1,000 annually, the definition of what qualifies as an emergency withdrawal is broad and seems to account for many circumstances. There is a new student loan repayment match where employers can help employees who are paying off student loans. An employer can make a matching contribution on behalf of the employee in 401ks, 403bs, 457bs, or simple IRAs with respect to qualified student loan repayments. This will be available to employers in 2024. In addition, younger earners can start contributing to an IRA with an expanded definition of earned income. Stipends and non-tuition fellowship payments to graduate and postdoc students count as earned income, and that means those students can contribute to IRAs. This is good news for students who want to begin accumulating tax-favored retirement savings. In many cases, graduate study keeps them too busy for a job that might offer a 401k or other employer savings plan. The new disclosures will show you how your total savings will translate into monthly income. This can really help with our discussions about your retirement, especially future cash flow and the income you'll need. Now you may be saying, I see how I'll have more time to save now. Can the new rules help me in other ways? The short answer is yes. The new legislation has made sweeping changes to how you can use your money, from 529 conversions to funding long-term care. Let's explore a few of the most prominent changes that you need to know about or that have broad application for investors. We all want to feel smart and responsible about how we handle our money. Now I'm going to share some parts of the Secure Act that will give you some new ways to use your savings. You'll have a new option for making your charitable donations more tax efficient. You're also going to be able to maximize college savings accounts, 529 plans, in new and interesting ways. Finally, there are some new reasons you can take money from your retirement account if you need to, without paying an early withdrawal penalty. You may be familiar with qualified charitable distributions, QCDs, and if you're not, QCDs were introduced in 2006 to help people age 70 and a half satisfy their required minimum distributions, RMDs, by making a charitable gift with the money in their IRA account. If certain rules are met, they can directly transfer up to $100,000 annually from the IRA to a qualified charity of their choice, and again, that donation would satisfy their RMD requirements for that year. Effective in 2024, the new law maintains the maximum transfer at $100,000, but will be adjusted for inflation each year. Now, it's important to note that it must be a qualified charitable donation. It's best to check with your tax advisor because there are some organizations like private foundations that are ineligible for donation under this law. Beginning in 2023, the new QCD law also allows for a one-time only ability to fund what's called a split interest entity, up to $50,000. It can get a little technical, so if anyone would like to discuss one-on-one, I'm happy to have a follow-up conversation. This rule change allows you to use money originally set aside for your kids' or grandkids' education. No need to dip into savings earmarked for retirement. Investors who have a 529 education savings plan can now withdraw up to $10,000 to repay student loans. We all know that student loan debt is a crisis in America. This new provision is one way that savers may find relief, allowing them to put less money toward student debt and more toward retirement savings. A related change is that 529 plan monies can also be used for apprenticeship programs, provided they are registered with the Department of Labor. Some kids don't go to college, but still need money to prepare themselves for the workplace. Now they can use the 529 plans their families may have already funded. And in case you didn't know or had forgotten, a $10,000 per year withdrawal to cover private K-12 education broadened the use of 529 plans in 2017. Do you have or anticipate having money left over in a child's 529 plan? This new rule could make it easier to save for your children's college and jumpstart their retirement savings too. Here are the details. Excess funds in a 529 plan can be rolled over directly into a Roth IRA for your child, the beneficiary. Beneficiary must have earned income. As with other rollovers, you are not taxed on the transfer of the funds, and the money continues to enjoy tax deferral until withdrawn. Beginning in 2024, you can roll over up to $35,000 total lifetime from the 529 plan to your child's Roth IRA. The annual transfers are also subject to annual Roth IRA contribution limits, currently $7,000. Another benefit to this rule is that there are no income limits for participants, meaning while high-wage earners usually make too much money to contribute to a Roth, they will now be eligible to do so for their kids or grandkids with leftover 529 money. There are some strings attached, however. First, the 529 plan must be in place for 15 years before it is eligible for a rollover to a Roth IRA. Money added during the past 5 years can't be used. If you max out the 529 transfer for the year, $7,000, the beneficiary, child, or grandchild can't add funds from other sources. You're capped at the annual limit for Roth IRAs. The bottom line is that we now have some flexibility when we have excess funds in 529 plans. 1, you can keep all the funds in the 529 without penalty, and your child can use the money for their children. 2, you can transfer funds to jumpstart your child's retirement. The best solution depends on your unique situation. Several new items have been added to the list of penalty-free withdrawals you're allowed to make from your qualified retirement account before age 59 and a half. Paying for long-term care insurance is now one of them. This is a tremendous benefit for a few reasons. As we age, more and more of us will encounter a major health event that requires long-term care, such as in-home medical assistance or a nursing facility. The high cost of care for an unplanned critical illness or health crisis can be catastrophic for families, and unfortunately, Medicare doesn't cover much. The average cost of a private room in a nursing facility can be $100,000 or more depending on where you live. Many people forgo LTC insurance because they think it's too expensive. But as you can see, so is the cost of care if you're caught by surprise. This new rule makes it more affordable and tax-friendly. Clarity is needed from the IRS about the type of LTC insurance that qualifies under this rule. The law is vague, referring to it only as high-quality LTC. If you have financial concerns about family health history or health issues, let's set some one-on-one time to talk about it. Then, we can explore your unique circumstances to see if LTC makes sense for you. This change is from the original 2019 Secure Act, but is worth repeating. Penalty-free IRA withdrawal of up to $5,000 per parent, if both have a qualified plan, is allowed within a year of the birth or adoption of a new child to the household. What we mean by that, it's not retroactive to children born prior to the 2019 Act. Twins or triplets, it's $5,000 per child per qualified parent, and we can discuss what those numbers look like if you're interested. To meet the requirements, the individual must take a distribution from the retirement account within 1 year of either the date of birth or the date on which the adoption of an individual under the age of 18 is finalized. Even though there will be no penalty, you may still owe taxes on the money withdrawn as ordinary income, unless Roth or after-tax contributions are withdrawn. The distributions can be paid back into the plan anytime without a time limit, but consult with your tax advisor on how to report this on your tax return and whether previously paid taxes can be recouped. And of course, it means less savings for retirement. So be sure to talk to a financial advisor to see if withdrawing this money is a good move based on your overall financial plan. Several new provisions have been made allowing for special circumstances. Now, early withdrawals will qualify as penalty-free for someone who is terminally ill, for victims of domestic abuse, for public safety workers, which now include firefighters and others. There's also been a provision made for expenses coming from a federally declared natural disaster. This rule is retroactive to disasters occurring in 2021 and later, and allows for a maximum distribution of $22,000, which may be both taken and repaid over 3 years. Retirement plan loans for people living in disaster areas are increasing from $50,000 to $100,000. Okay, undoubtedly some of you have already accomplished saving enough for retirement. Kudos to you. Now you're starting to think about the next generation and estate planning and wondering, what do we need to know about leaving our IRAs to our kids? Is that still allowed in the new rules? Unfortunately, the news here isn't so good. Our fourth key point is that your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. This was a big rule change in 2019, and it's worth addressing today. Not only are your retirement savings affected by these new rules, but the death of the stretch IRA requires a review of your estate plan thinking. Let's look more closely. With certain exceptions, which we'll see in a moment, beneficiaries of IRAs, including Roth IRAs, must liquidate the accounts within 10 years. Previously, IRA owners were encouraged to have younger beneficiaries because they could stretch out the distributions over the beneficiaries' lifetimes, allowing for longer tax-free growth. Some heirs even plan to use the accounts for their own retirement, but now they must take out the money within 10 years of the death of the original owner. This could have major repercussions for the beneficiary. When they withdraw that money, they will have to report it as income and pay taxes. This could also affect the FAFSA, the student loan application form, if they have children applying for college financial aid, and possibly limit their ability to claim certain tax credits. There is no rule about how to draw down the account, provided it is gone within 10 years, so the beneficiary could take out some each year for 10 years, or none for 9 years, and then everything in the 10th year. A clarification to this rule has been published pertaining to whether the original owner had begun taking RMDs and how that should be handled. I'm happy to discuss it with you afterward. Planning is needed, and this should include consulting your accountant. If you have a large IRA balance and know it will be part of your estate, please let us know if you have questions. As I said before, there are some exceptions to the 10-year rule, or what the IRS calls eligible designated beneficiaries. They include surviving spouses, disabled or chronically ill beneficiaries, those who are not more than 10 years younger than the original owner, and minor children. In that last case, the 10-year clock starts when they reach legal adulthood and doesn't include grandchildren or other relatives of the original IRA owner. For all these eligible designated beneficiaries, the stretch IRA is mostly business as usual. The new rule also does not apply to people who have already inherited an IRA, only those who inherited in 2020 or later. The real lesson from all these changes, particularly the death of the stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue, and one way to do that is to eliminate tax breaks. We may see other changes before the time comes for you to retire or pass on your estate. For many years, even decades, people were told to rely on IRAs, and many Americans listened to the point where, helped by a 10-plus year bull market, they have a lot of money invested in these tax-deferred accounts. The problem is, one day, the tax bill will come due, and you can't predict what the tax law will be when it does. As I've said, I'm not a tax professional and I don't give tax advice. All tax decisions should be reviewed by your accountant, but I can look at your investments and savings and help you plan ahead. Taxes in retirement are a much bigger issue than many realize. I can help you develop a retirement income plan so that you draw down your accounts in a tax-smart way. Some of our strategies might include Roth conversions, managing your tax brackets, reviewing your beneficiaries, including trusts, and creating an estate plan that makes the best sense for everyone in your life. Hopefully, I've conveyed to you the importance of the new retirement rules brought by the Secure Act, and you can see how important it is to focus on what's going to be most impactful for your life. You're probably wondering what your next steps are. First, let's look at the key points we've covered. We started our presentation by saying the Secure Act changes the retirement rules, and that means current and future retirement plans need to be reviewed and adjusted. Our first key point: the new provisions of the Secure Act give you more time to save for retirement, but you need to know how these provisions work so that you can take advantage of them. Our second key point: the Secure Act gives you more ways to save for retirement. Our third key point: the Secure Act provides smart and responsible new ways to use your money. Our fourth and final key point: the death of the stretch IRA means that your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. Thank you again for watching. If you have any follow-up questions, please do not hesitate to reach out to me directly. Our office number and my email are on the slide. As always, we appreciate your time and hope we answered some questions for you. Tune in next month for the next video in our financial planning webinar series. Thank you.